Let me ask first about this whole cord cutting, or now cord shaving, that's really hurt media stocks over the last month. It started off kind of with Disney, because ESPN is the big star of Disney's media enterprises, and it seems that some people have been shaving that out of packages. It's amazing that someone could live without ESPN. I know Alex could not.
Could not. That's true.
Is this really happening? Are people just shaving down what they need and taking smaller a la carte packages?
No. There's so much confusion in the video market. And it's easy to say investors or consumers or viewers are jumping off of the video bundle, but it's really the best value, and that, in our view, is not actually what's happening. There is the market's mature, and it's clearly not growing, and probably declining slightly. But you have to break up what's happening. First of all, with Disney, they had given a forecast just over a year ago on ESPN subs and modified it based on slightly slower subscriber forecasts and also currency. Their contracts are written differently than other programmers. They allow for tiering. They've pushed price pretty hard, and they don't have to be carried by 100% of pay TV distributors. For other programmers like Fox and Time Warner, they're pretty much 100% distributed. And so they've seen really good affiliate fee growth. Fox in particular has seen really strong affiliate fee growth. Our view is that the video bundle will not completely fall apart, as many investors think right now. There will be loads of offers, skinny bundles, whether it's Sling or Verizon or Amazon or
Skinny
Hulu. Bundles
are an offer of less content for less money, basically.
Exactly. So people will pay less and get a lot less. And, so our view is that you're not going to see, for example, Cablevision, they view themselves as a connectivity company. And they've publicly said that they have not seen people migrate down to these skinny packages. They're actually seeing the phone ring from new people coming in.
And by the way, this idea of a skinny package, even though it's gotten a lot of press recently, is not new. Skinny packages were offered 5-7 years ago, and ESPN, we reported on this, I remember, about 5 years ago, had a clause in a contract with I believe it was Time Warner Cable, maybe it was other operators too, that said, will allow you to offer a package without ESPN, but if it becomes the most popular package, or even the second most popular package, then you have to kick ESPN into it, and it never did. So it wasn't really an issue for them.
Well, let me just add, that's interesting, and I do remember that you could get cable bundles that didn't have Bloomberg, for example, though I never chose that. When we see these stocks, and we were just showing some of them coming down 5 or 10% in the last few weeks because of this kind of
the media meltdown.
Exactly. Should we view those then as a bargain? I mean, does that mean this is the time to get in if that's not really happening?
Yeah, I mean, there are certain companies that are going to be well protected on the video side, and then there are, of course, many other drivers, which I'm happy to talk about if you want to.
Yes.
But the companies that the companies that are really well protected, in our view, are the parent companies of Hulu, meaning Fox, Disney, and Comcast, which owns NBC Universal. Because if there really is a skinny package, which again is not our view, the one that will have it all would be a Hulu sponsored, but they haven't announced anything. I don't want to start a rumor. But you would get in a Hulu package, the parent companies, you get sports, kids, general entertainment, reality, nonfiction, et cetera. A huge package, a pretty diverse offering. So we think that they're well positioned. They have the strongest networks anyway. Probably throw in Time Warner and CBS as well. But each of those companies, Comcast, Fox, and Disney, have many other drivers.
It's part of the reason why John Malone has been so public in saying his vision for content is to roll up what he calls these free radicals. In other words, Jessica just listed about 5 companies that are fairly well positioned in content. That means there's other companies that aren't so well positioned. Talking about AMC or Starz, which he owns, or potentially Discovery, another company that he owns a part of, Scripps. His idea is, well, maybe the idea, if we're not all that well positioned, is to put these companies together, and at least now we'll have some networks that people want to watch, and we can bundle them up and have some leverage.
So those are the companies that you think are well protected. Give me some equities that you wouldn't touch. What do you not like out there?
I mean, Viacom is not one of our favorite stocks, and we think they're vulnerable. I mean, I think the kind of the bullish view is that it's an inexpensive stock, it's a value stock, and our view is that it's a value for a reason. Their ratings have been down dramatically for the last 3 years. And, so there have been issues. They've obviously bought back stock and propped up the stock. But we think where the vulnerability will be over the next 3 years will be in the networks that really, where the ratings have declined a lot. Those are not must-have networks. And they just can't force distributors to take every single channel. So if they're getting 10 cents or 15 cents a sub per month, they're going to lose 100 or 150 million per channel for these weaker channels that really should not be on the air.
And that's why they'll consolidate and then scrap off some of the lower networks if they have to.
All right. Real pleasure getting you for even only a few minutes, Jessica. Thanks so much for dropping by. Jessica-Reif Cohen there from Bank of America, Merrill Lynch. Alex Sherman here with us, our media reporter as well.